I just want to say hello and welcome. Thanks for joining today. On behalf of the entire Tavola Group team, we're really glad that you're here to dive into the year-end tax strategies to maximize business savings. The last quarter of the year is really your best opportunity to reduce your tax bill and plan ahead. Today, we'll focus on practical strategies that can be implemented before December 31st to keep more of what you've earned. This doesn't just apply to Q4. A lot of the strategies that Danny and I will walk through today really apply year-round. It's all about the proactive strategy. My name is Matt Schumacher, and I am the Director of Tax Planning here at Tavola Group. I'll be hosting today's session, and I'm thrilled to be joined by the one and only Danny Torres. He's a CPA and the Director of Tax here at Tavola Group. Today, we'll cover key strategies to uncover deductions and credits you might be missing, maximize Section 179 and depreciation deductions, optimize contributions and charitable giving for tax efficiency, and much more. This session isn't just about compliance, it's about smart planning that protects your profits and strengthens your financial future. Quick disclaimer before we dive in, Tavola Group and its employees do not provide legal or investment advice, and the strategies we discuss today are for educational purposes only. Please consult with your own attorney, accountant, or financial advisor before making any financial decisions. So about Tavola Group, our name really reflects our philosophy. In Italian, Tavola means table, and that's exactly how we see our role, sitting beside you during the critical financial conversations that shape your business's future. We believe true financial clarity happens when your accountant, advisor, and attorney work together, not in silos. That's why our integrated approach combines tax strategy, planning, and proactive guidance to help clients make smarter, more confident decisions about their money. Whether it's optimizing deductions, minimizing taxes, or planning for long-term growth, our mission is to help you align every financial decisions with your broader business and financial goals. Tax planning isn't just about filing on time. It's about making strategic decisions now that can save money, reduce risk, and strengthen your business. Smart year-end tax planning can help you save more with tailored deduction strategies, reduce the risk of audits and penalties, boost cash flows through better timing of expenses and income, support long-term business goals, preserve wealth with tax-efficient planning. In short, it's all about keeping more of what you earn and making sure today's decisions set you up for tomorrow's success. Now, I'm really excited to introduce Danny Torres, our speaker for today's webinar. Danny is a seasoned tax professional with 17 years of public accounting experience, specialized in tax advisory, compliance, accounting, and consulting. He earned his accounting degree from the University of Texas at Austin and a master's degree in accountancy from the University of Texas Pan America. Danny brings a proactive, solution-driven approach to help businesses identify tax opportunities and manage risks. Outside of work, he enjoys spending time with his wife and 3 children, watching sports, and connecting with family and friends. Danny, thank you for joining us. I'll hand it over to you to dive into the strategies that can help business owners maximize savings before year-end.
Awesome. Thank you, Matt, for that warm introduction. I'd also like to welcome everybody to today's webinar. Appreciate you having a bite possibly at this time, and maybe not sacrificing your lunch, but enjoying your lunch as you uncover hopefully some helpful strategies for you. And as Matt mentioned, today we really want to highlight and emphasize, how important strategic year-end planning and positioning can be for you and for your business. On here is kind of an agenda of what we'll be kind of uncovering today, and we'll go into more detail in the slides that follow. So shifting over to the next slide, we have basically the power of year-end planning, right? Right now we're in the last quarter of the year, and it's really an important time to take advantage and invest in yourself, invest in your company. We here at Tavola Group choose to focus and really have these working sessions with our clients and be very strategic about how we navigate ourselves, especially at the end of the year. We have an intentional plan to try to become a little bit more aggressive as far as thoroughly reviewing everything that we can. But basically, the whole end goal is to make decisions now that can result in some big savings for you and basically provide a roadmap for what's to come. And so oftentimes, with that being said, when we look at common year-end oversights, Um, as we get the books and we look at our clients, we realize that, you know, many business owners have, you know, unintentional money left on the table. As we look at our books, our strategic positions, we oftentimes find that there are, you know, some missed opportunities there, right? And so our whole goal is to try to not miss those particular types of strategic positions, and really have an intentional plan to invest in your company, invest in yourself, to help avoid paying taxes that could have legally been avoided by deploying strategies to help lower your taxable income, right? And in our next slides, we'll begin to kind of really dig into some of those more common examples that we often advise our clients with. And we'll kind of get into some, hopefully some things that you guys will consider with your advisors, with whoever it is that you may be working with, as far as strategists, you know, financial advisors, or CPAs and attorneys. So we shift over to our next slide. We really dig into one of the strategies that we often look to, and that's something called Section 179 depreciation expense, right? And what this does is, as we go and purchase assets that are, you know, necessary or oftentimes potentially strategically purchased for the purpose of writing off certain types of assets, it's really great to look into utilizing this type of expense, because there are times where instead of being able to kind of just expense certain things, they have to go on the balance sheet as your assets. And when they're qualified, certain types of assets, you can actually immediately expense them by utilizing this strategy. And in 2025, some of you may have heard, but the One Big Beautiful Bill Act came into existence, and it actually doubled the amount that you're allowed to take as Section 179, and you're able to take a $2.5 million expense on assets that you place into service before you know, the end of the year and in 2025, right? And then there are times in which, you know, Section 179 doesn't make sense, but in a lot of ways it does, right? In that if you're profitable, you really want to take advantage of this so that you can write off some things, especially some things that aren't available to you in real estate, for example, with non-commercial type assets that are placed into service that may qualify you to take an immediate deduction, like roofs or HVAC systems, security systems, those type of things that typically get depreciated over time, can be immediately expensed in the current year that you place them into service. But one caveat with this that you have to be cognizant of and aware of is that 179 does get limited to your net income that's available to you. So, and it basically cannot create a loss. So you have to be strategic in how you place and use this, because anything that you deduct using 179 expense, if it gets you down to below zero, it basically gets carried forward to the following year and cannot be used up in that year of service. But there's another option available, which is something called bonus depreciation, which we'll look at and examine on the next slide.
I have a few questions. This seems like a topic. I'm going to defer the 100% bonus depreciation question someone prompted here for the next slide.
Okay.
But is there a couple quick questions here? Is there a limit on how many assets I can deduct before hitting the phase out threshold?
A limit on how many assets you can deduct?
Yes.
So the max phase out threshold is $4 million, right? So up to that amount, anything of that gets phased out, and you're no longer able to deduct anything past that $2.5 million worth of Section 179.
Okay. And then I saw a question here, and just so everyone knows, please put the questions in the chat. If we don't get to them right away, I promise we'll do a catch up at the very end. There's quite a few on this one. Does used equipment qualify for this deduction, or does it have to be brand new?
No, used equipment does qualify, as long as you place it into service in that year. So if you're making the purchase of a used piece of asset that you are buying new for your business, it will qualify you for it.
Okay. And then I'll save the 100% bonus depreciation question for the next slide.
So as I mentioned, there are some potential limitations to Section 179, but that being said, there's something that is available to taxpayers as well called bonus depreciation, right? And that can actually be used in unison with Section 179. And so what you can do is maximize the amount that you're able to take with Section 179 and then defer your other assets using bonus depreciation. And so unlike Section 179, there is no limitation on bonus depreciation, and it can actually generate a loss. So, being strategic with that and how and which ones you end up using for that particular year depends on the assets that you guys are purchasing for your business. But basically, one major component within the 2025 tax year that you really have to look into is the key date of January 19th, 2025. Because any asset you place into service before this time gets captured under the old rules, which only has bonus depreciation up to a max of 40% of that particular asset. But if you bought anything after that date and before 2025, and you actually placed it into service in the 2025 tax year, they retroactively applied the 100% bonus rule. So it's a huge advantage to, or I guess, opportunity to take advantage of in anything that you're purchasing that becomes a fixed asset and not just a normal operating expense, can be bonused and or oftentimes called just basically written off an expense within that year up to 100%. And I know, Matt, you said there was a question on this, right?
Yeah, actually, I got a follow up to this. Is the original question? Let me read that. Was 179 useful, even though we have 100% bonus depreciation? Then this person just sent another. To be more specific, can I just use bonus depreciation and ignore Section 179?
You can, and there's no limitation or phase out or max on that. But there are certain assets or certain types of assets in which bonus is not eligible for, i.e., HVAC systems in real estate that are for like non-commercial or non-residential type buildings, in which you cannot take bonus, but you can utilize Section 179 that would end up allowing you to take that immediate deduction. So there are certain nuances within that, or certain ways in which you can use the game of both to really take advantage of writing off the entire amount of certain types of assets that are placed into service.
Awesome.
Okay, so that being said, it's a good segue into this slide, really, because we're talking about timing things, right? And we talked about Section 179 and bonus, and that involves basically purchasing assets before year end to take advantage of certain deductions, which is what we're going to discuss here, right? Depending on what type of accounting method you're on, being cash or accrual, perhaps a modified approach. There's some companies that have a modified type of method of accounting, but in general, I mean, you ideally would like to accelerate as much expense as you can. So if you're a cash basis taxpayer, you can expense, prepaying some insurance, office supplies, office expenses, rent, professional fees, etc. Right? Or as we talked about, purchasing assets that can be used using Section 179 or bonus depreciation. And then there's also the aspect of bonusing employees, packaging perhaps some charitable contributions, which both those two have some more slides coming within that. But in addition to just accelerating expenses, there's also the deferral aspect and component of your company and your business, right? And that is deferring when you recognize income, be it delaying services that you delaying invoices that you perform, and or perhaps if you're going to sell an asset or sell a portion of your business, maybe utilizing an installment sale method in which you capture only a certain portion of those proceeds from that sale in the current year, and then defer off for another year or another 2 years or X amount of years, and just kind of kick the can down the road for that the gain on the disposition of those assets that you have, or the disposition of the sale. So the biggest thing is to coordinate with your CPA or your accountant, and make sure that based on your particular accounting method, if you're on the accruing expenses, meaning you can pay those out in the following year within the next month or two, and just actually capturing the expense now and creating the liability, and not having to dispose of or liquidate your cash flow. So just make sure that based on your accounting method, that you are working with your advisor to ensure that you're able to kind of really take advantage of how you time out your either expenses or recognizing that income. And as mentioned in talking on the next slide for bonuses, it was briefly mentioned here in the slide before, and on this timing expense strategically slide. But if we look at year-end bonus planning, right? This is a deduction that can be taken to help reduce taxes. As we talk about to paying your employees, is really taking advantage of, instead of, I know we look at our profitability, see how much money we are able to kind of generate throughout the year, and then reward employees because of that. Well, it might be best to kind of project that out, and or perhaps time, incentives, or motivate your employees in recognizing that before year end, right? So having a quota or something for your employees to meet by November or even October, and compensating that out by before year end, and getting the expense for it at that point in time. But that serves two things, right? I mean, it creates a tax deduction for you in actually compensating your employees before year end. But more so, and I think what actually helps drive a business more than anything, is it creates that that motivation, that morale for your employee, in that it also helps to tie out, generating additional profits for the company. This is a great tool to use to kind of help definitely keep your employees happy while reducing your taxes at the same time. And that goes in line with, and it really ties into, on our next slide, retirement contributions. Unless we have any questions, Matt, do we have anything that we want to?
I got a few questions here. First one is, can I hold off on billing customers towards the end of the year, or hold receivable payments to reduce my income?
Okay, so on the invoicing side of charging customers, that part is where you would want to ideally delay, because there's something called constructive receipt, in which if you actually invoice it, and just because you don't collect it, for example, if you're on the cash method, technically you perform the service, you've sent out the invoice, especially if you're on the accrual side of things, you would technically have to recognize that income at that point in time, which really ties in to the receivable side, if I understood that question correctly.
Gotcha. And the other question we received in this section is, if I prepay my January rent in December, can I deduct this year to lower my 2025 taxes?
Absolutely. And actually, the play with, for example, like rent and insurance, you can actually do that up to about 12 months. So if you have the disposable income now to prepay a full years in advance, up to 12 months, you can really take advantage of doing that at that point in time.
Awesome.
So yeah, I was tying in year-end bonuses with retirement contributions. They oftentimes go hand in hand, but this is a great year-end strategy to also take advantage of, right? I mean, ideally, you'd like to maximize the amount that you can contribute towards retirement, be it through 401k, SEP IRAs, defined benefit plans, anything that you're doing to contribute it before the end of the year, and particularly if you're a cash basis taxpayer. But if you're on the accrual side, you can actually accrue for that as well. But this truly helps you as the owner taking those deductions, but also your employees and you yourself as well on the retirement aspect of it, right? Because you're taking a deduction for what on the company side of things that you're doing to help contribute towards the employees' retirement plans, taking advantage of that write-off. But then in turn, whatever it is that you and your employees are actually contributing to the plan are further deferring your income. So you're not having to recognize that, income that's appreciating and accruing in your retirement plan, and all that continues to grow tax-free and is being deferred down the road for whenever it is that you actually do withdraw it. One thing to mention and to be just aware of as you are looking at how much to contribute, how much you want to compensate yourself, and match those retirement contributions within your compensation package, is that your contributions cannot exceed what your earned income is. So you really want to get with your advisor if you want to max your retirement out and you're only at a certain amount salary wise, to be able to ensure that, hey, well, I want to max this thing out. Well, then you have to make sure that you're matching your wages, your active earned income, if it's a partnership or so, that there's enough income there to be able to absorb the amount that you're able to contribute and max out on the retirement aspect.
Danny, here's a very specific question, but it says, as a small business owner new to having a 401k plan with my employees, do employer contributions to employee retirement accounts also reduce the company's taxable income?
Do employer contributions also reduce? Is that what?
Employer contribution to employee retirement accounts also?
Yes, okay. Absolutely, right. So now you're using the matching component and or the profit sharing component. So anything that you're doing on the employer side for your employees counts as a deduction for your business, which in turn lowers your taxable income, creates great rapport and employee perks for your employees, which ends up generating great employee retention. So again, a lot of these strategies that you're implementing are definitely tax favorable, but at the same time are helping your business thrive because you're able to retain these employees that are great for your company, great for your business. They take care of your customers, your clients, while also taking care of the business. And so, yeah, it's a great tool to use to your advantage. So another item that is a great tool to use, especially towards year end, and you looked at, your, throughout the year that you've had these perhaps charitable contributions. Now we're getting towards the holidays. We are at year end. You're looking to see how much you've done throughout the year. There are ways in which you can give to charitable organizations that can truly help drive down your taxable income. This really hones in on the personal level of things because it's more of an itemized deduction. You can take the deduction at the business level, of course, but it flows down to, if you're a pass-through entity, flows down to your personal return and gets recognized and on the itemized deductions section in Schedule A. But there are things that you can definitely take advantage of, right? And I know back in 2017-18, when the new TCJA Act was enacted, there was a limitation imposed on, or should I say, actually, I'm sorry, not a limitation. They doubled the standard deduction, which made charitable giving a lot harder to kind of take advantage of in, addition with your mortgage interest, your property taxes, your medical expenses. But one thing that can be done is to kind of group things on the charitable side of giving. So for example, you can take advantage of appreciated stocks, right? So say you've purchased something, some stocks or mutual funds, or even like real estate. You bought something for like 50,000. Now it's worth for, let's just call it 150,000. That's what the fair market value of that is. There's that built-in gain component of $100,000 within that specific example, right? Well, what you could do in essence is donate that appreciated asset directly to a charitable organization and take advantage of the write-off of not just the 50 that you purchased it for, but the $150,000 that it's now appreciated to, and offset your taxable income within that space as opposed to the 50,000. And so you've deferred $100,000 in gain, not recognized tax on that, and then in turn are able to write off the 150,000 against your taxable income. So that's a great tool to use if you have some funds available or some assets that have accrued that you just may not particularly need, but would like to help out an organization, is a great advantage or a great lever to kind of use to your advantage. Another is something called a donor advised fund, in which you can contribute to this donor advised fund. Let's say that's a $30,000 contribution that you want to make, right? But you may direct that fund to say, hey, I'm gonna donate $30,000 now, but I'm only gonna have you contribute to that organization, over the next six years, $5,000 per year, right? Well, it's not the amount of the pledge that you're able to deduct, meaning that 5,000, you're going to be able to take a $30,000 deduction for what you contributed to that fund that will be pledged over time. So it's just your commitment to that particular charitable organization over time that you're able to kind of immediately expense and accelerate in the year of contribution. So another lever, and something really worth exploring, and this is a nuance there, because there's so many different particular aspects of business tax credits that you can take advantage of. But the one big takeaway with business tax credit versus business tax deductions is that these credits are dollar for dollar reductions that are often overlooked, but that you can definitely take advantage of in writing off your tax liability, right? So as opposed to an expense in which you get a $100,000 deduction and you're in the, let's just say, 35% tax bracket. Well, that deduction counts as 35% tax savings, meaning you get a tax savings of $35,000. Well, if you have a credit worth $100,000 and you have a liability of $100,000, that $100,000 tax liability ends up getting reduced dollar for dollar based on your liability that you have and the tax liability that's there available for you. So tax credits can definitely be much more lucrative at times than a deduction. But it's just something that you need to explore. There's R&D tax credits, there are work opportunity tax credits, there are energy investment tax credits. But the one big thing to kind of look at as you look to navigate on how you may want to invest in these types of credits is looking at the provisions that are currently enacted within the, we mentioned the One Big Beautiful Bill, but there are some provisions within that bill that are sunsetting some of these provisions, and they will go away, some in 26, some in 27. And so as you work through them and you see how certain things may apply to your business, you just want to work with your CPA or the investment company in which you're working with to ensure that whatever you're using to take advantage of it before that provision ends up perhaps potentially expiring in.
One quick question here: does service-based business still qualify for the R&D credit, or is that just for tech companies?
No. There are, for example, engineers, architects that may be using some sort of ingenuity type of way in how they service their customers. They may use a certain aspect or component of technology to implement how they're servicing. But no, it's not strictly for tech companies or manufacturing companies. It's anything that is innovative to your type of company and how the wages that you're paying for it, materials and supplies that you may perhaps be using to incorporate whatever it is that you're using, software that you may purchase that you're developing to drive your service. So it's a combination of certain things. All right, so moving on to pass-through entities, partnerships, S corps. Really what you want to kind of look at here is kind of optimizing payroll, adjusting your salaries and or distributions to, one, make sure you're in compliance, right? For example, S corps, you as an S corp owner, you are liable and responsible for compensating yourself through the form of W-2 since you're actively involved in that company. But then you want to just be aware of that, you want to find a good balance point based on your retirement goals, based on what your goals are for payroll tax savings, that you're looking at that nice balance of how much you should actually include for yourself as far as W-2 goes, and then utilizing the distribution of profits to further compensate yourself. So that takes some more planning with your CPA. You just want to make sure that you're looking at it from that aspect. Same thing happens in partnerships, in which there are some things called guaranteed payments, in which some of your partners, for being a little bit more perhaps actively involved than some of the other partners, get a bit of a guaranteed portion of that level of service that gets compensated over to them aside from their distributions of profits. And so there may be like a fixed component within that. You just want to make sure that you're looking at it, because that in turn drives some self-employment tax, which is a higher payroll tax that you have to pay on top of your federal income tax. And so you want to look at things holistically to say, okay, I want a guaranteed amount, yes, but then there's also that component of like, okay, but we also want to look at our distributions to ensure that I'm not overpaying myself and subjecting myself to more payroll tax while being able to take advantage of those distribution of the profits that are just a return of capital. And then the last thing, which is it will segue into the next slide, but just to kind of touch up on it, is something called the pass-through entity tax, right? And on here, businesses are able to deduct state taxes paid at the federal level by utilizing this pass-through entity tax, which reduces federal taxable income, reduces sometimes the base that on the state level you end up getting taxed on based on what the business is at for taxable income there. And then the respective owners and the shareholders or members of an LLC, however that entity is taxed, being a flow-through entity, receive a credit for their portion of the state tax obligation. And so this is a great tool and lever to kind of utilize to pay tax based on the anticipated profits of the company, get a deduction at the entity level, and then the respective owners get their share of their credit towards their state tax liability on their K-1s, and can offset some taxable income there. And like I said, that really goes into kind of our next slide in looking at state and local tax strategies. The PTED is a great option, right? But in addition to that, you really want to look to, I guess, look at and examine your compliance requirements, especially if you have multi-states. One of the biggest things that we often see in our industry is that we are not as, I guess, attuned to how your business is operating, but unless we're obviously having these working sessions and we're actually talking about it and being very much proactive. But there's oftentimes exposure to multi-states when you're operating remotely or operating in one state but selling across state lines. You really want to limit your exposure through income tax, through sales tax, any of those types of taxes across the different states, because the states have their own requirements on what is considered nexus, meaning what an entity may be liable for income tax or state tax for. And we sometimes see notices that we just weren't aware of, that the company is operating in a particular state that has different requirements that are different than one state. And so this is a very nuanced area, and you really want to make sure that you are informing your advisor, your strategist, your CPA, whoever it may be, and that you inform them that you're operating in these different locales, that you have states there, that you have sales to those states, that you have either employees or contract workers in those states, which means you have a physical presence there. Just anything that could potentially trigger any sort of compliance requirements, let them know, because you ideally would want to minimize your exposure for being not in compliance in these particular areas. Moving on to our real estate and using depreciation, as you know, we touched on depreciation, right? But a great lever that you can use to deploy, especially you have some disposable income. You may have perhaps a spouse that is not as actively involved in another line of business that has some time to delve into real estate, or you're a real estate professional and you have plenty of real estate available to you that you can utilize some losses to offset other taxable income. There are certain, a little bit more advanced tax planning strategies like cost segregation studies that can help accelerate depreciation and, drastically increase your deductions that are available to you. In particular, if you're a real estate professional or taking advantage of something called a short-term rental loophole, in which you have certain hour requirements, certain qualifications that you need to meet for either one of those types of options. But these types of deductions are tax engineered studies that are done that dissect the components of the real estate property that you're purchasing, and you're able to really offset a ton of that by accelerating your depreciation and moving it, as opposed to depreciating it over 27 and a half years if it's a residential property, or 39 years if it's a commercial property. And so utilizing some of these types of, and the beauty of it is you have to make the investment, of course, in purchasing the asset, but it doesn't all have to be by cash. You can finance it, but these types of deductions are non-cash types of deductions. So you're not liquidating yourself. You're not having to use a whole bunch of cash to take, $100,000 write-off in taking depreciation expense versus recognizing that $100,000 over the next 10 years. And so that's one lever that's great that we've been utilizing for a lot of our clients. It's tremendously helped lower their taxable income. And on the deferral side of things, there are definitely ways in which you can defer income by using 1031 exchanges. And that allows you to, if you already have a particular property, to, in which, especially if you've taken, depreciation and lowered the value of that, of the net book value of that particular asset, and you've recognized another piece of property that is more lucrative for you, then you can go and purchase that property by exchanging. You basically work with an intermediary, let them handle all the transaction itself. You never touch the money, but you go and defer quite a bit of gain potentially and move that on to the next piece of property. So you're selling one asset, picking up another, and deferring a lot of that built-in gain that's within the asset that you have, and buying a more expensive piece of asset that will hopefully derive more revenue for you. But in addition to those tools is, making sure that you are taking advantage of your expenses, tracking to make sure that you're tracking all your hours, especially if you're taking advantage of some of these more strategic real estate professional or short-term rental loopholes, and tracking your hours and time so that you qualify for those particular types of statuses. But don't leave anything on the table as far as mortgage interest, repairs, taxes, insurance, things like that.
Hey, Danny, one question on the real estate. It says, can I use my rental property losses to offset income from my business?
So that depends. That's a big, it depends. And it all is a matter of how active you are in the company, how much income you are generating throughout the year. Because if you're considered a passive investor and that real estate is just more of a passive type thing, and you exceed, I believe the threshold's $150,000 of AGI, and your income's coming in and it's higher than that, well, then those losses become limited from the real estate side of things. So it's all a fact and circumstance type of position when it comes to real estate losses. And so you just really want to coordinate with your CPA and your advisor to see, based on what it is that you have in your portfolio, how you can strategically place yourself to take advantage of those types of losses. All right, so the next thing, I know we've talked about a little bit on the types of accounting method that you're on, cash, accrual. If you've been in business for a while, you've already been established in one sort of aspect, right? I mean, we talked about the timing of things. If you're on the cash side, maximizing your expenses now, deferring some of that income. On the accrual is recognizing and accruing some potential expense that you want to maybe wait to incur into the following year, but actually recognize the liability now, while accruing that expense. And so the biggest thing is if you're barely starting up or wanting to implement a new company, I think that's when the accounting method becomes extremely important. You'll know your operating business more. You'll know the life cycle of that business. And so you want to strategically place the type of accounting method that you're going to use based on how your business is going to operate. So if you know you're in the business in which you get a ton of cash at the end of the year, you might want to consider accrual so that you can accrue some expenses. But again, that all just takes discussions with your accountant to ensure that whatever it is that you guys are going to start operating under, that you are recognizing the proper accounting method for that. And then the other aspect of this, and it's a little bit more of a complex issue, but it can definitely be a great advantage to take advantage of from a tax savings perspective, is to consider switching the method that you're operating under. And so if you've been in business for a while, just because you've either been in as a cash or accrual business throughout all this time, doesn't mean that you cannot switch to a different type of accounting method. But this definitely takes a lot more planning, because there is a little bit of a complex issue that you need to incur what's called a, you need to submit to the IRS and let them know that you're going to send in a Form 3115, which is a change of accounting method, recognize based on your switch how that's impacted your prior either income or losses, and how that will get recharacterized in the year that you're making that switch. And so that is definitely a more complex area that you would definitely need to discuss with your CPA or your advisor or strategist, but something that can definitely be taken advantage of if it will help you, especially not just in the now, but in the long run. And so if we look at the next slide, and the it kind of goes in hand with that, looking at the financial statements and ensuring that they are really proper, they're accurate, there is a proper recording of transactions. The biggest thing here is that you want to, if you have an internal accountant, or if you're just using an external, or have a combination of both, that basically the books are aligned with what's been done internally, and then how that gets captured on the external end of things. Meaning, if you have an in-house accountant, that they are properly recognizing your books, recording expenses on the expense side and not picking them up as incorrectly as assets, or picking up expenses as assets when they shouldn't be. And then in turn, if you do have those kind of books and your CPA has reviewed them and then they've made changes, that you basically have your accountant in-house capture those changes that were made to ensure that everything's aligned with either how it should be recognized from an internal aspect, and then how it should tie back to perhaps your tax returns and how those were filed. And so oftentimes when the books are not accurate and are not clean, it creates a little bit of a, I guess, convoluted mess in when we're looking at them. And I say we, when the CPA is looking at them, it can create, lengthiness in us getting things turned around faster for you and as a client. But not only that, it becomes a lot harder to properly plan for, because we're having to do cleanup and having to do compliance work just to ensure things are done right, versus having a good, clean set of books and making sure that, okay, this is your true position. Now's here we can start to implement our strategies. Here's how we can actually strategize going forward based on how things are properly recognized where they should be, and what your financial position actually looks like. One big thing that we often look at with our clients is the entity structure. Here at Tavola Group, we often advise our clients to look at things not just at one point in time, but try to look at things fluidly. There are times in which you might be a sole proprietor, and it may make sense to make you either a C Corp or a pass-through entity, right, as a tax savings component. So the entity structure at the beginning stages of it all, in which you're discussing that you may want to start a new business, or the business has been existing and it needs to shift perhaps because of either bringing on new partners or bringing on new shareholders or exceeding certain revenue thresholds that require you to shift over to a C Corp, for example. You just want to make sure that from a compliance standpoint and of course from a tax strategy standpoint, that you're looking at how you're structured that can end up driving a whole bunch of tax savings for you down the road. So you just want to make sure that you are constantly looking at your growth, who you might be bringing on as far as partners or who you may not be bringing on, and it's just you, but that there's this level of growth involved here that you can align and shift some of your income simply by switching over the type of structure that you're taxed as. And then in turn, as we talk about all these different levers that we're able to kind of put together from a documentation preparation standpoint, on the next slide, we often find that our clients that are very well organized, that have things lined up, that they have controls in place to ensure that there are they're timely invoicing or timely sending out collection notices or receiving receipts on things that are due to them, have contracts buttoned up, lined up, anything that we've asked them to implement, that they have those items properly documented for audit proof purposes. There's just so much within here, tracking your employees' time, ensuring that they are, submitting reimbursement expense type items. You just want to make sure that you have a system in place that helps serve as backup for everything that you're putting together from a financial statement perspective. Because by being this organized, it allows your business to thrive, be efficient, but having all that supporting documentation available to you further helps your CPA, us as your advisors, basically have all the information readily available, so that if we ask you for something, if we want to look at a clean set of books, if we want to look at any supporting documentation such as contracts, operating agreements, whatever it is that you may have, that we really have that available to us so that we can further properly plan for the current year and for future years. And then really this leads to kind of our closing and basically how this all kind of ties in together, right? And so ideally what you do now provides kind of a roadmap for the following year. I kind of introduced the topic this way earlier, but just because we're planning at this time of the year and coordinating at this end of the year, this last quarter, it doesn't mean it stops in 2025. What we're doing is setting that financial roadmap, those tax strategies that are being implemented based on your facts and circumstances and what you may anticipate and what your goals are. And it's really done to basically highlight the importance of tax planning, and that it's not always just about tax planning, right? And as obviously we all want to not have to pay so much in taxes, but when you really think about tax planning, it's all about strategically positioning yourself, right? For example, I mean, you may be able to go out and purchase a $100,000 vehicle that can definitely save on tax, but if it's going to liquidate you, does it make the most sense to buy that type of asset when you may need it, but not completely, right? But all you're doing is spending on a piece of asset that's going to depreciate itself, not be the same type of value, versus perhaps using that amount of money and investing in like real estate that will appreciate in value. So the whole aspect of this and the whole goal is to align your portfolio, align your goals, and then find the most tax efficient way on how we can implement certain strategies to get you to that point in time. And so utilizing some of those items mentioned in the slides above is a great start. It's a great conversation starter, and it's a great way to start saving taxes now and to continue to defer that income recognition to future periods. But that's really where I think I will wrap up with, Matt, unless there are any other questions that we have.
Yeah, we actually have quite a few questions. I'm going to limit it to these last two right here, Danny. But I promise if you put a question in the chat, Danny and I will respond back to you after this with an email. Appreciate everyone's participation. Here's one with entity changing and timing considerations. It says, if I expect higher profits next year, should I consider changing my entity type now in anticipation of the higher profits?
So it just depends. I mean, unfortunately, that's it depends type question, right? Like, how are they currently structured? But it's definitely something that is something that you obviously should consider. And we talked about deferrals is perhaps delaying some of your expenses. We talked about accelerating expenses. Perhaps you might want to delay some of those expenses to push them on to the following year to offset that anticipated higher profit year.
Awesome. And then the last one has to do with quarterly estimates is, can I adjust my estimate tax payments to avoid penalties at the end of the year?
Yeah, absolutely. So oftentimes this does happen. We typically back end our estimates, or we front load them depending on the client circumstances. But you can obviously always catch up and either prepay. If you have a flow through entity, it definitely serves two purposes because it creates a tax deduction for you at the federal level. And then you've already paid in towards your estimates that you anticipate. Or, estimates are typically due for individuals in January. You look at to see what your profits are, and then you can kind of make that fourth quarter estimate at that point in time.
Awesome. Thanks. So before we close, I want to make sure everyone on here knows that there's a simple way to turn what we've talked about today into real savings. Tavola Group offers a free tax planning session where we will help you uncover deductions, reduce your tax bill, and plan for growth, whether you're a business owner, an investor, or a high income professional. There's no cost, no pressure, just practical guidance to help you finish the year strong. You can schedule your session through the link in the follow-up email or reach out to us directly. It's an easy step that can really pay off before December 31st. So that wraps up our session today. Thank you all for joining and for your thoughtful questions. Our contact information is on the screen. If you'd like to reach out directly to Danny or myself, you can schedule a free tax planning consultation through the link we'll share in the follow-up email. This webinar recording will be available on YouTube within the next day or so. On behalf of Tavola Group and our entire team, thank you again for spending the time with us today. We look forward to helping you make the most of your financial future.